I think the main misunderstanding is around the potential persistence of inflation, in the sense that I think markets are veering too much towards the idea that inflation is certain to continue, when it really isn't. The underlying inflation pressures going into the Gulf War were very limited, and we're not really seeing the second round effects of inflation that would normally mark a more prolonged episode. So I think the market is sort of fixated on the 1970s or the 1990s and how oil prices affect inflation, and it's a different world, and that's what's being misunderstood. Well, I don't think it's fair to characterize all central banks as doing the same thing. So, in my view, the European Central Bank has committed a policy error because it's living somewhere around 1973. That they think this is a big risk, that there's a risk of inflation expectations, and those inflation expectations are going to have economic consequences. Well, firstly, there's little evidence of inflation expectations responding to higher oil prices, and secondly, inflation expectations only have consequences when there's things like pay bargaining power, which there isn't today. So the ECB, I think, is stuck in the past and fighting old battles. For the Bank of Japan and the Reserve Bank of Australia, which have been raising rates, they're in a different position because they were starting from an accommodative stance earlier this year. And I think that they are more or less looking at the current situation. The Bank of England, the Federal Reserve, I think, are also more or less looking at the current situation. There are some voices on the Fed who are perhaps looking at past battles, but generally I think other central banks are looking at the world as it is today rather than looking at it as it was in the past. At the risk of using a jargon term, what we have is the Wile E. Coyote effect. In the Roadrunner cartoon, Wile E. Coyote runs off the edge of a cliff, carries on running through thin air, and then eventually economic gravity works and he goes down. That was always the scenario with the Gulf War, that what has happened is consumers were drawing down on their savings to pay for the higher oil price. So they didn't have to cut consumption. They could cut back on savings, maintain consumption, and still afford higher oil prices. That's the running through thin air. If the savings run out, you collapse down. Now, what I think has happened is that with the seeming resolution of the situation in the Gulf, or at least more oil starting to flow through, we're now in a position where we're not likely to get that collapse. And so the key word, I think, for the economy in 2026 has been resilience in the face of shocks.